But let me also get in Harish Krishnan, co-CIO, Head of Equity at Aditya Birla Sun Life Asset Management Company. Harish, good morning. Great to have you with us here. Thank you very much for your time. I think we're talking for the first time since the GST cuts, Harish. So, it's a much debated topic in terms of how much boost this will give to overall consumption, basically leaving a little bit more money in the hands of consumers. Whether categories where the cuts are will see increase, or the money will find its way into other categories. So just that question, Harish, how have you and your team thought about this? You must have had discussions, and has your approach changed in any way?
Yeah, I think clearly there has been a pivot from the government side to move into demand side stimulation. Over the course of from 2018 to 2023 and 24, the focus of the government was clearly on supply side, investment, capex, PLI, etc. And there seems to be a material shift in that orientation. So that is the more important point to kind of look at, especially given how investment theme has done so well in the last 5 years and the consumption theme has underperformed over that same time frame. Most of the funds and portfolios are also significantly invested in that investment theme and underinvested in the consumption theme. So that has got market implications. Now, coming to the actual boost to the economy, apart from the sentiment perspective, I think it's a reasonably good boost, both from a function of the tax cuts that got announced in February, wherein, close to about anywhere between 75,000 to 1 lakh crore kind of potential savings would accrue to the top 15% of households, because those are the ones that actually do end up paying taxes. And this one covers the entire set of population, which would be, again, as per what the government itself has put in, a net benefit of anywhere between, say, close to about 50,000 crores. But that's the here and now. I think the bigger thing is, if these kind of things continue, I think it is going to lead to a lot more economic activity. Also, one of the key pushbacks of private investment has been the fact that demand has been a bit soft, and therefore there really is no real tearing hurry to kind of do investments, given the obsession that corporates have for ROEs. I think that also kind of changes a bit. So I think net, it's a very big positive, and it will require a significant change in portfolios. We've already kind of positioned for it. But I think market will start recognizing it more than the here and now of how the festive quarter, etc., kind of plays through, but more from a bigger perspective of how positioning and underinvested the overall space is.
Hi, Harish. Great to have you on the show. I was just looking at the consumption fund that you guys run, and it's fairly well diversified, right? I think it has representation from telecom, some banks like ICICI Bank as well, of course, names like M&M, ITC, so many more. So the question really is, how do you, can you effectively and efficiently also play consumption through the financials? Or is the direct route simply better? Go own the hotels, or own the airlines or the travel companies or the footwear makers? Or is the financial route a good route? And if that's the case, then what sort of financials? Because banks are very diversified. They have large, corporate books as well. And then you have a few names like Bajaj Finance on the retail side here and there. So just help us clarify the link, playing consumers through financial.
So this was the same argument, say, about 3-4 years ago, where that as the investment cycle comes through, you're going to see financials also being a way to play that same thing. And quite honestly, we haven't really seen that happen, more because they were over-owned at that point of time. Financials, were the go-to place for most funds, given the significant weightages they had in the index, etc. And they were significantly over-earning their profits from very high NIMs, very low credit costs, and the stocks just didn't perform. So therefore, to make that connection that now, here and now, consumption will start to fly and banks or lenders are going to benefit from that, I think possibly may not be, the argument that we really have. The argument for financials, of course, is that, you've got today an environment where, about the larger banks, about 4 or 5 large banks have got a significant access to capital. They're trading above book. Most of the rest of the private banking space is just about there. And therefore, in an economic environment where, competition is not coming through very significantly as far as the banking space is concerned, I think that the overall economic activity, which is to potentially double our economic size over the course of maybe the next 7, 8, or maybe 10 years, the banking system will do well. So I don't think it's necessarily just a play on consumption. It's a far bigger investment thesis that of the supply side within the banking system actually being far more kind of in control and in check. Given the regulatory environment that we have, and that's what makes us positive on the larger private sector banks in many of our.
All right, Harish, good to see you. And Harish, just hold on. I just want to focus on one stock. That's Oro Pharma. That one's bucking the trend. That's actually the high point of the day. As we speak, I think it's up close to around 4% or thereabouts. The news report that came in earlier said that GTCR is nearing a deal to buy the generic drug maker Zentiva. Remember, the street was a little bit cautious that Oro is looking to buy an entity that is too large. There was a fear of dilution, fear of debt in the books as well. So in that sense, the street could be viewing it as they are the lucky loser. So that's the reason why that stock is up. Harish, in the past, you've spoken about the diagnostic, set of companies. I think you all were quite bullish on there. How do you focus on, how do you play this? Pharma, till now, it's been protected from those kind of tariffs. The diagnostics, hospital chains as well, they are looking interesting. There's a longer runway, but your take, how do you approach healthcare?
So from a US generic piece, I think there are some significant one-off molecules that have boosted profit pools in the last 18, 24 months that are likely to go away. And that's almost, of the aggregate profit pool, close to about 15 to 20%. And therefore, as we look at the next 18 months or so, I would imagine that the profit growth in the pharma complex, especially focused on the US generics piece, is kind of going to be underwhelming. So we've kind of actually booked profits as far as the US generic piece is concerned. What we have kind of focused on, as you rightly pointed out, is on the diagnostic piece and the domestic pharma piece, where we do think that there are some interesting trends that we've seen. So coming to the diagnostic setup, COVID gave a leash of life for a lot of unorganized players, given the fact that there was an excessive focus of testing. And this brought in a lot of new competition. A lot of online platforms came in with significant price cuts, etc. And this, obviously impacted the pricing power of the incumbents as well as the potential for making profits. And therefore, we've seen their stocks being on the receiving end over the course of the last 3 years or so. Fast forward to 25 and 26, what we are seeing is that the competitive activity has kind of eased up. Even the aggregator platforms have actually started increasing their pricing as they have started focusing on their IPOs and their potential to create profitability from their significant loss pools that they're currently having. The third aspect is that, the incumbents are also focused on getting volume growth compared to just the margin expansion, which to our mind is the right strategy from a longer term perspective. And the fourth aspect is just the hypothesis that we have that, in India, we are going to see a fad or a significant kind of a move towards GLP-1. And given the fact that, this is going to be at a very large base of population, we do think that there is going to be testing that is going to actually take off as doctors, physicians, as well as patients become a bit apprehensive in terms of potential side effects, if any. And therefore, that will also lead to a boost as far as demand is concerned. So this is our thesis as to why we think that diagnostics are reasonably well placed from an overall perspective over the course of the next 2-3 years.
I know that's very well put, Harish, and explained. Just a couple of more names, right? Oracle Financial Services is up, but it's the largest volume traded stock. Although I think I saw a flash from Oracle saying Oracle Finance saying that there's no real impact of what's happened in the US from Oracle and what Oracle has done. The Oracle stock parent was up 36%. Here, in terms of the business, there's no impact, but there's, I guess, some rub off. Jupiter Wagon is coming up as the second largest gainer now. It's a small name, but 8% on Jupiter Wagon. Indocount is another one, which is up 5.5%, 300 rupees. Third largest volume gainer on the NSE. There's Mostship, which is back up about 4% after, I think it took a break for 2 days on its way up, but it's coming back. And look at Tollens, which is Tollens Tires, 11% higher. I think it's a recent listing, 196 or so on this one. And it's within the top 10 volume-led gainers right now. Phase is something which Hormuz put out, and it's got volumes, but it's up 2%. Sagility is another one which is up about 4.5%, and so on and so forth. So lots of movers coming into the mix as we go through the motions. The first few minutes as far as market opening is concerned. Harish, just as we can sort of wrap up now, right? And it's, of course, as you said, it's going to get more and more, as the general belief is, again, selective from here. I know you're a close macro watcher as well, and currencies is something that you watch closely. I mean, look at what's, of course, happened to the rupee here. Any implications off of that as you look ahead?
So, from a release valve sort of thing, the government response to the tariffs that have come through from the US, which have been unfortunate and not clearly as per script, has been in terms of depreciating the currency. So the dollar itself is depreciated against most other currencies, and the Indian rupee is depreciated even against the dollar. In fact, against all trading partners calendar year till date, I think we've seen a fall of anywhere between 5% to 20%. So there has been a significant let-off as far as the currency is concerned. Now, this, to our mind, has implications actually on the IT sector.
I think we're losing the
because the slowing down of revenue growth, that they'll be growing at 2-4%.
Harish, go on. Please finish. I mean, I think we're losing the line towards the faggot. Go on.
Yeah. So while there has been this fear of revenue slowing down, but I think the greater fear that we had was, if the rupee were to appreciate close to about 80 because of the dollar weakness, then the margin leg for various IT services is actually in a very poor shape, and therefore there would be a further cut. I think with rupee where it is, I think that pressure of margins actually goes off. The revenue thing, like I said, expectations are quite low. It is an under-owned space. And I think, from a dark horse trade, while in the first 3 months we had private sector banks, metals and cement as the dark horse trades, now we do think that it is going to be IT services as a contrarian dark horse bet, as well as consumer, both in terms of consumer staples and consumer durables. That is where we are kind of incrementally allocating capital to kind of take into cognizance these kind of.
Okay. All right, Harish. We'll leave it on that note for today. Slightly troublesome line as well, but we got the gist of it. Thank you so much for joining in with the perspective.